Welcome everyone to our Dynamic Wealth Management Market Update for October 5th, 2015. I'm Grant, this is Gary. Usually we have Adam Carlini with us as well. He is celebrating his 28th wedding anniversary this week, so we wish him well and hope that he returns safely.
The purpose of our video is to just give you a quick update on what's going on with the market, maybe the economy a little bit, and specifically to let you know how we're reacting in our models to what's going on in the marketplace. So let's go ahead and jump into things, and away we go.
Okay folks, let's get you started with the main risk indicator that we have. As you can see here, it is three zones: bearish, neutral, and bullish. And we are in the yellow zone still, slightly to the left, but still in the yellow zone. Remember, the significance of each of these zones is that as we change from red to yellow to green and back the other way, we are actually changing the allocation mix within our models. Now let's go over some recent economic events, and we'll just highlight three key things that were market moving, and Grant will talk about those more when we talk about the price action. The first one was on September 17th, and that is when the Fed chose to keep short-term rates the same. Along with that, they also gave commentary that one of the reasons why they kept it the same was because of weakness globally, especially in areas like China, and that sent a message to the markets and sent us down for the next 6 or 7 sessions. More recently, we had our monthly jobs report that came out, and the market was anticipating the creation of about 203,000 brand new jobs, when all that were created was 142,000 brand new jobs, along with some other data here that we won't go into detail over. But basically it was weaker than expected in the job sector. And this one came out just this morning, October the 5th, and as you can see, it also showed a slowing in the non-manufacturing sector of the economy, or the service sector. Now, to be fair, it is still a strong report at 50, but you notice the trend also again downward, and mirroring what we're starting to see in manufacturing overall. Now I'll go ahead and turn the time over to Grant, and he will talk about how that translates into market action.
All right, Gary did a great job of giving us some economic events. Now let's see how those economic events have affected the market. Here's a chart going back to 2007. We see the big drop of 2008, then the bull run in 2009. In 2010, we had a little scare. In 2011, we had about a 20% drop, and the market has been on a strong bull tear since then. Now, the last few months, we've had about a 10% pullback in the S&P 500. Now, the big question on everyone's mind is this the beginning of a next 2008 drop, or is this just a small drop like 2010, or even like the drop that we had in 2011? Now, here's a zoomed in look at the S&P 500 over the last 6 months here. Now, what it shows is that we've been trading in a range, but at the end of August, we actually had a big downdraft. This is where we had about that 10% drop, a little bit more. And it stopped here at 1867, came back up, rallied till back over 2000, but then it stopped and dropped, came back, retested the bottom, and has gone straight up since then. You can kind of see the W formation here. Now, what was it that pushed those changes? Well, the first one is, it's really the three economic events that Gary talked about. The first one is the Fed holding off on raising interest rates. The market did not like that. The market fell down. It was assuming that the global economy and China's economy was weak, and that's why we saw this downdraft here. Then we had a poor jobs report come out. The market liked that. And then we had a weak service report come out. The market liked that as well. So the story is that bad news is good news again, meaning that people anticipate as we continue to get bad news and as the economy weakens, that the Fed steps in and does not raise rates and could even start stimulus again, which would push the markets up most likely. Now, what does that mean for our models and our allocations? Well, as Gary pointed out on our risk indicator, we are in the yellow zone. We've been there for about 6 weeks now, but we've dropped beneath this red line into the bearish zone twice, but we have finished up out of the red zone, which has kept us in a yellow allocation. So what that means is that if you are a growth client, you'd be about 60% in the stock market and about 40% defensive at this point. If you are a moderate client, you'd be about 40% invested in stocks and equities and about 60% defensive. If you're a conservative client, well, you'd only be 30% invested in equities at this point and about 70% defensive. Now, we want to be clear that you don't make any decisions based on the recommendations in this video alone. We are not making any specific recommendations for any specific person. You should consult with your financial advisor before you make any financial decisions. We do have a couple of events upcoming here. We have a seminar on October 27th that will be held in Sun City Grand. We'll provide a dinner there, so if you're not a client, come meet us. We'd love to have you there. Give us a call to RSVP to that. Also, we do a breakfast club in the office every 2 weeks. So we have one tomorrow at 9 o'clock a.m. on October 6th. We'll do another one on October 20th. It is just some conversation about the markets and where things are headed. So please call us with any questions or feedback that you might have, and we'll put another video up soon. Thank you.